everybody. Welcome back. We got Dan Golden with Cross Country Mortgage with us again. How you doing, Dan?
Doing great.
Excellent. So,
Surviving.
Is surviving? Is that what you said?
Surviving.
That's good. We're going to hit number 2 as far as surviving. So it's so funny. Everybody talks about the mortgage or the real estate bubble. It's coming, right? And even though we try to prevent you from getting a misconception of where we're at, the however is at the end of the day, really there is a mortgage lender or a mortgage bubble. Would you agree?
So to speak, yes.
All right. So we're going to go over that. Make sure you subscribe. Dan's contact information, we will put that in there along with a link to his website. And if you have additional questions, because at the very end, he's going to tell you about a very unique program and why you should consider it, because it is also based on rate, but not a funny rate. It's not like, hey, you have a sneaky buy down. It's a real rate. Is that right?
That's right.
Okay, we're going to save that for the end. So, the mortgage bubble. First, how significant, Dan, is then the media is going to, take this, it's a big deal. Like, oh, since 2020, it's the biggest drop ever.
Yeah, so you're seeing a lot of, the rates going up, and then all of a sudden recently they said, hey, the rates just dropped 20 basis points this week, and they made a huge deal out of it because, it was somewhat of a significant drop.
Right.
But when you look at the scheme of things, we're still in that 5% interest rate range, which is still way higher than we were 6 months ago. So it did go down, which is nice.
It is.
But I think it might be a temporary dip. Sorry to give bad news. If you're looking to buy, I would probably jump now and get into that rate because I think it's going to go back up again. But when that happens, I don't know.
Good time to lock?
Good time to lock. Good time to, if you're on the fence, jump in.
Jump in.
Yes.
All right. So remember, you can only lock once you have a signed purchase and sale agreement, correct?
Actually, we have a program where you can lock.
Oh, sure.
Forgot to say that. We have a lock and shop program now. You can lock for up to 90 days with a 30-day extension without a property. You have to be fully approved, underwritten approved, which is not a big deal. I can do that really quickly.
Yeah, but you're one of the only guys that actually do that.
I don't think very many people do it. And now, on top of being able to get fully underwritten approved, you can lock in the rate for 90 days. You are paying for a 90-day lock, but you don't have to have a property. So that's kind of nice.
That could be a big deal, especially like from, what was it, from March, all the way through May.
Yes.
That would have been a big deal.
It would have been a huge deal.
Because they could have locked in the low 4s.
Right. So I think now might be another big deal.
Yeah.
Because you can lock in at, let's say, 5.
Right.
Or maybe even under 5.
Okay.
And that will take you through the summer. And then there's also a 30-day extension on it. So it's really 120 days.
That's
you got to
big.
Close in 120 days.
Yeah, because normally you have to have a signed purchase and sale agreement between a buyer and seller before they will even consider locking your loan.
Right.
And that is a big deal.
It's a big deal.
Yeah. All right. So, see, you gave them a little teaser before the end of the show.
I wanted to surprise you.
I love it. Okay, so really at the end of the day, even though rates have been going up, boom, we see a 20-point basis. So 1 basis point is like, 0.1%, right? So 100 basis points is 1%.
Right. So let's say a quarter, like 20 bips, it's about a quarter in rate lower.
That came down.
Yes.
Which is going to be valuable, especially for buyers right now that have been struggling or right on the edge, or folks that just got priced out. Hey, that brings back a little bit. That $100,000 haircut that everybody took, you just got some of your hair back, which I wish that would help for me. I'm always hopeful.
I'm not going to say
All right, let's talk about this. This to me is the big one. This is a monster. Yeah. This is important because you could just about lose your mortgage if you're not careful.
Right.
Massive lending layoffs. We mentioned this briefly. Dan, Money Store, Better Mortgage, Wells Fargo, Keller Williams Mortgage, Rocket Mortgage, Mr. Cooper. We've got Nation Star. We've got there's gobs and gobs. We're talking thousands, tens of thousands of mortgage lenders that are getting their pink slip.
Right.
No notice.
Right.
That means that, and the next on the line is going to be the processors. They're next on the hit list, right?
Yep.
So these guys that go to some of these online places that let's call them limited services, that they work in such small margins that they hope for the volume. Now that the volume has gone away, now they're laying off people, which means what?
It means your loan could go into a black hole, essentially. If you're pre-qualified with one of these lenders, you might get a call all of a sudden, hey, your loan officer is no longer there, the person working on your loan is no longer with us, and now you're assigned to this other person who knows nothing about your loan and probably has other loans that are priority over yours. So to answer your question, service goes way down, and you could lose your approval.
You could lose your approval.
Right.
The problem is if these guys, so if somebody has waived their financing, right?
Yep.
Oops. Unless you had another protection, that earnest money that you had probably just went away, because now you need a way to justify why you can't get financing.
Right.
Okay. And unless you had somebody else like Dan, okay, that how long have you been in the industry now?
Going on 30 years.
I would never say anything about that. I've been there the same amount of time. But people have been around for a while. They have a proven track record. Are you getting laid off?
No.
Excellent. So,
and I made it through the '08 crash, and I made it through other crashes. So I've been through this before. This is not new.
This is not new.
This isn't new.
Yeah.
So I feel like I'm prepared for it.
Right.
So these companies have to lay these people off because they just, like you said, the margins are so thin. They don't have the capacity to keep these people employed.
Right.
So
It's limited service folks right now. This is where they struggle. The problem is we don't want you to be hurt. This is where you need to be super careful and make sure that loan is in process. And if you all of a sudden you're not getting responses, you're not getting feedback, you're not getting updates, people aren't returning your call, your email, your text message, and you're starting to sweat and stay up at night, you might have a very good reason as to why, especially if it's on the list, because that is a major concern.
Right.
And we don't want to see anybody get hurt. We will have Dan's information. Dan can do an 11-day close, which is super awesome. And many times, well, actually in the past, Dan has saved many of our clients that have gone to discount companies and last minute crash, especially with the big box. Wells, Bank of America, US Bank, Chase was a classic one, a couple of there.
Yep.
Had last minute, Dan has come in and helped them, right? That's the super benefit to that. Dan's got a great team. That's why he's also here giving us the feedback, giving you the feedback that you need to make a better business decision, right?
Yes.
Moving on. How can a seller prepare to be non-contingent in today's market?
So one thing I've been noticing is I'm getting a lot of calls from people who say, "Hey, I want to buy a house. I own a house. I have a bunch of equity. My house value's gone way up, and now I want to buy a house, but I need to go non-contingent because my agent says I need to go non-contingent, or I'm not going to win the offer."
Right.
Non-contingent meaning you have to not have to have the
requirement.
You don't have to have the requirement to sell your house in order to buy the next one. So my first question is, you have to have a down payment. So where's your down payment coming from? Oh, well, we were going to use our equity. So then my third question, whatever, is, do you have a home equity loan on your house by chance? No, I don't. Okay, it's too bad you don't have a home equity loan on your house, because you could use that for your down payment for your new purchase, and then go non-contingent. So if you think you're going to sell in the next 4 to 6 year time frame, like you're not quite ready to sell and do this move up or move down or whatever it may be, but you think you might, you need to get a HELOC now. Right now, not when you're a month away.
Sure.
Because you're going to be asked a question when you go to apply for that HELOC. What are these funds for? And if you are about to buy a new house, you have to say, I'm about to use this money to buy a new house, right?
Right.
Well, you're now non-owner occupied on that HELOC, because if you're not going to be in the house that you're moving out of, even though you are in there now, in the next 6 months or 4 months, or in the next few months, they're going to look at that as you are moving out now. You don't own or occupy that property, and it's going to be very difficult for you to get a HELOC, because
if at all,
most lenders do not provide non-owner occupied HELOCs.
Right.
So you will have a problem getting that HELOC and pulling that equity out. And normally I'd say, oh, well, let's just do a non-owner occupied cash out refi. But you are not going to like what that looks like on the rate and fee. It is insanely expensive.
Right.
So if you think you're going to sell between 4 months and a year from now, I would go get a HELOC right now. I can do HELOCs myself, but I also have a couple referrals that I put out there that are good banks that do them that I have a connection with, and I'm happy to refer those out. So if you need a HELOC, call me, and I will help you figure out the best option.
Yes. The key thing is, and understand, a HELOC is a home equity line of credit, all right? It's like a second mortgage. And the benefit is that you're able to leverage the current equity in your home to go ahead and use that as your down payment. Naturally, you sell your home, but then during a offer with a seller, you're coming in saying, hey, I am good to go. Here's my down payment. I can close. I do not need to sell my house. I can keep this as an asset, okay?
Right.
And that's a super helpful thing. But this doesn't happen overnight.
No.
It takes, 60 days?
Well, right now, because the rates are so high,
Yeah.
people aren't doing cash out refis
Oh.
to get their equity out. They're doing home equity lines.
Oh, which makes more sense.
So if you do a home equity line, which is like you said, it's a second mortgage, like a credit card attached to your house, but it's a lien on your house. Every bank out there is quoting 45 to 60-day turn time,
Right.
because everybody's out there trying to, if they want their equity out, it makes 0 sense to do a cash out refi because the rates are so high, and most people have below 4% interest rates. Well, cash out refi is above 5. You're not going to do that.
Right.
So
Right.
you can go get a HELOC, and that HELOC is interest only. The rates are decent. They're in the 4 to 4.5% range, and they are flexible. You can not take a draw and not pay interest on that money.
Right.
So it's like a credit card. If you don't use it, you're not paying interest on it. And then when
2%.
you're ready, you can pull out.
Right.
So that's a cool thing about it. Even though I'm telling you get a home equity loan now, you're not paying on it until you draw the money out. So you don't really need it's a no-brainer in my opinion.
Right. It's there if you need it.
It's there if you need it.
Which is the best part. It just gives you another tool for what you want to do.
Yeah.
And anyway, so that's I think great feedback. That's
Yep.
one of the things that we wanted to let sellers know. Hey, here's an alternative, because there's a lot of folks out there, that are saying, God, I got gobs and gobs and gobs of equity, but that's exactly it. It's equity. And what I tell folks, equity has zero value until either you sell it or leverage it.
Right.
So you're leveraging that to get into your next property, whether it's upsizing, downsizing, whatever it might be, lateral sizing, to a second home or whatnot. Right. And then you do whatever you're going to do financing wise.
Right.
So with that, that's a really great opportunity. Again, minimum cost, talk to Dan about it. Takes time. Plan 60 days for this. Now, in the beginning, we said that there was something super special that you were going to let them know that
Yep.
is not really available out in the open market. This is something that just came out for you?
We've had it, but it's I think what you're referring to is our lower rate option.
That's correct.
Yeah, so the 30-year fixed rate right now, on average, if you look at the Freddie Mac website, 5.1, there it is right there, 5.1 for a 30-year fixed. It's around 4.3 for a 15-year, 4.6 for a 15-year, and then an ARM is about around 4.25. So we have a 30-year fixed rate mortgage for highly qualified people. You have to have a decent down payment. Between 15 and 25% down. You can do as little as 15% down. No mortgage insurance on this loan, and it is around 4.6. So it's about 0.5% lower. You have to have good credit, you have to have reserves, and you have to have a decent down payment.
Okay.
Those are the 3 caveats. So that's a disclaimer to
Well
that.
financed.
Yeah, you have to be well qualified.
Hey, let's hit something really fast. Not to diminish that. That's super awesome. Yeah. Guys, that is an incredible rate considering par pricing today. Is typically a bit higher. And if you are interested, again, we will post that. Let's hit a really important financial question for, some of these folks that are considering, gosh, I don't want to spend 5.25% on my mortgage because, hey, I'm not going to be in my house for 30 years. I'm going to be in my house for 10 years. Mm-hmm. Would you recommend a 30-year mortgage today?
If they're only going to be there 10 years?
Yeah.
10 years, I would look at a 7 or a 10-1 ARM.
Okay.
Most likely, if they
Why?
for sure were going to be out,
Yeah.
because the rates on a 7-year arm, and when I say 7 and 10-year arm, that means it's fixed for that period of time. So a 7-year arm is a fixed rate for 7 years, and then it becomes an adjustable rate for the remainder of the 23 years.
Right.
But it is at a lower rate than the fixed rate, almost 1 full percentage point, 3/4 to a full percentage point. You can get these in 5-year fixed, 7 and 10. So they are good programs if you know you're going to be out of your house out of that loan, let's say,
Right.
either by selling it or refinancing it or paying off with inheritance or whatever it may be. If that loan goes away in 7 years or 10 years, you're better off paying that lower rate.
Totally agree. When we look at the disparity, this has always been my frame of thought is anytime we look at disparity of the rates being at least 1% or more. So like the example that we just showed, because we'll pop that up there again. You know, if an ARM is at 4.1, but yet 30-year financing is at 5.1, 5.2, even today, which is, that's really good. That's a massive savings to people when they're looking at it.
Yep.
Now, one of the questions that comes in, we call this a 5 and 1 or a 5 and 6.
Yeah.
I've had that question. Would you answer?
The 5-1 or the 1 is gone. So they stopped doing that. Was that was when the ARMs were based on the LIBOR.
Okay.
So the LIBOR was a 1-year recurring rate. So
it would adjust.
It would adjust every year. So after 5 years, it would take an adjustment at the 60th month.
Right.
If you did a 5-1 ARM.
Right.
And then every 1 year after that, it readjusts. It'll stay fixed for a year, adjust, fixed for a year, adjust.
Okay.
So now they've changed. They've gotten rid of the LIBOR.
Okay.
And now it's a different index, and it's every 6 months. So now you go on the same example, fixed for 5 years, 60th month, they're going to look at the index plus a margin, and I can explain that individually. It's kind of a longer explanation. Then they're going to add the index and margin to that index, and it's a moving index. It can go up and down over time, and then that's going to be your rate for a year. Or excuse me, 6 months. 6 months.
Right.
Now it's 6 months. And then 6 months later, they're going to do it again. They're going to look at that index, readjust every 6 months. Now, what's interesting is like last year, people would call me and go, hey, my 7-1 ARM is about to adjust. What do I do? And I told them nothing.
Stay.
Because the rate actually went down or stayed the same. There was no reason to change it, but unless you were worried that the rates were going to go up and you wanted to jump into a 30-year just to lock it. So anyway, you have to pay attention to that when it comes close to that time frame.
Sure.
And then start looking at that, okay, and I can help with that. I can say, okay, well, this is where it's going, because I can look at the index, the margin, and say, this is what you're going to adjust to.
Right.
And so maybe you should do this or that, take this path or this path, depending on what works best.
Sure.
Your long-term goals.
So each one is a case by case as they're doing this.
Yeah.
All right. Again, we're going to post Dan's information for you guys so you can take a look at it. There's no cost. There's no obligation to reach out to Dan and his team. Yes, he has a team, so he will also respond to you quickly. And if you feel that you're in jeopardy of your mortgage, or the mortgage lender is all of a sudden is ghosting you, as we say, they're crickets, you're not hearing anything, reach out to Dan also, because you may need to have your backup plan in place, especially if, like most of the time we have tens and tens of thousands of dollars tied up in an earnest money, no financing contingency, other issues or other contingencies have been resolved. And your biggest issue then is protecting your family's equity. All right. With that, we will see you on the next video. Dan, thank you again for coming in. I appreciate it. You guys have a beautiful day. Remember to punch subscribe because that lets us know that we're giving you the right information, and it helps others see this information so they can make a really good business decision for them and their family. Anyway, thank you very much. Dan, thanks. I'll catch you guys on the next video.